Well, we want to thank everyone for attending. We have a great discussion scheduled for today. We'll start with some introductions. I'll kick it off. I'm Adam Sporn. I'm head of prime brokerage and U.S. institutional sales at BitGo. I joined BitGo earlier this year after spending 20 years in traditional finance. I worked in prime brokerage and securities lending, covering institutions at Morgan Stanley, BNY Mellon, and most recently State Street. And my journey from traditional finance to crypto is very much driven by the institutions. Over the last 12 to 18 months, more of the institutional clients I covered started entering the digital asset space. I wanted to leverage my experience and BitGo's solution set to help clients safely enter the world of crypto. I'll turn it over to Jody for an introduction.
Thanks, Adam. I'm Jody Metler. I'm president of the BitGo Trust Company. I've been with BitGo for just about a year now. Similar to Adam, I come from 20 plus years of experience in traditional finance, largely in the payment space at Citibank. Joined crypto because of the institutional adoption, driving a new asset class for our investors, and just the excitement around it. So I'm going to hand it off to Jeff Horowitz to introduce himself.
Hi, everybody. I'm Jeff Horowitz. I'm the Chief Compliance Officer here at BitGo. I've been here almost 2 years. And prior to that, I was the Chief Compliance Officer at Coinbase for almost 3 years. And prior to that, spent 25 years as a global head of compliance and/or AML at shops like Citigroup and Goldman Sachs, and 12 years at Pershing, a subsidiary of BNY Mellon, one of the largest custodians in the world. So super excited to have made the transition into crypto and haven't looked back in the last 4+ years.
Great, thanks for that. So to set the stage, I'm going to provide a high-level overview of BitGo. Jody's going to provide an overview of our custody platform and how we protect client assets. Jeff's going to review our compliance structure, some key considerations for clients, and provide a regulatory update. And then I'll conclude with some trends we're seeing across the different verticals of institutional clients. So BitGo's evolution as a business tells the story of a developing market infrastructure. 10 years ago, we chose to invest in wallet infrastructure to sit at the intersection of institutional capital and builders. Our founder and CEO, Mike Belshie, pioneered multi-sig technology for crypto all the way back in 2013. 2017, we became a regulated, insured, qualified custodian. 2020, we launched our prime brokerage unit where we offer trading, borrowing, and lending. And so far this year, we've launched staking and DeFi solutions with more to come. But it's that wallet infrastructure and security that is our DNA. This is what powers our vast product suite, hot, cold, DeFi wallets, staking, NFT support, and a unified API that gives clients access to over 25 layer ones and over 600 tokens. So if you can think of BitGo in a 3-layer pyramid, at the base, this is our wallet technology. It's our SOC 1, SOC 2, Type 2 audits. This is our $250 million insurance policy against loss or theft of keys. And this middle layer, this is our regulations and compliance infrastructure, is what Jody and Jeff are going to be spending their time covering in this section, in their sections. And this piece is critical for our institutional client base. And this is what separates us from technology providers out there offering custody solutions. Our top layer, this is our prime brokerage offering. We aggregate liquidity from some of the largest market makers and exchanges, allow clients to trade out of cold storage on the BitGo platform. And then we borrow from clients looking to earn incremental yield on their longs and lend to clients looking to borrow to facilitate their liquidity needs. So institutional clients require high operational compliance and security standards that only a regulated, qualified custodian like BitGo can deliver. We have over 700 institutional clients in 50 countries. We have 14 offices, over 350 employees. And this allows us to offer a follow-the-sun model when covering our clients. With that, I'll turn it over to Jody to provide more details on our custody solution.
Thanks again, Adam. Thank you. So qualified custody, and this is the meat and potatoes for today, right? So qualified custodian is approved by regulatory bodies to hold assets on behalf of clients. At BitGo, we actually have 4 different regulatory bodies that we have trusts within and qualified custody. So we have the BitGo Trust Company based out of Sioux Falls, South Dakota, the New York Trust Company, our Swiss Trust Company, and our Germany Trust Company. All regulated, all compliant by all the different regulators you'll see here on the screen. So this So what is this? So let's talk a little bit more about what custody actually means. So cold custody, this means it's also referenced as cold storage. They're offline wallets for digital assets. With cold storage, the digital asset is stored in an offline platform that's not connected to the internet. And in BitGo's case, that's this bank-grade vault. This protects the wallets from hacks, unauthorized use, and other vulnerabilities. And unlike unregulated software solutions that you might hear about in the market, they are not regulated. So they're not beholden to any other strict, regulatory compliance that Jeff's going to talk about in a little bit here. They don't have mature control processes, proper audit and compliance representation. And at BitGo, we also have a $250 million insurance policy against hacks and misuse by our employees. So we talked about it at the beginning, and actually the title of this demonstration is Not All Custody is Created Equal. We deliver the most robust and compliant and secure product in the industry. Our custodial wallets are secured by multi-sig and cutting-edge TSS technology that help us mitigate against single points of failure. We have an integrated crime solution that Adam talked about as well. So it provides liquidity from the security of having an asset held offline. Our product set also spans lending, escrow, and staking. And as we talked about in our intros, our team is led by seasoned Wall Street veterans coming from State Street, Morgan Stanley, Coinbase, and others, Citibank, for myself. We have over 700 institutional clients in 52 countries and 350 employees across 14 offices for follow the sun support and 24/7 access to your assets. So what does it mean to onboard to trust or to a custodial, a qualified custodian? So onboarding, it goes through a very stringent compliance review. There's going to be about 6 or 7 documents that would need to be provided for institutional clients, including W-8s, a certificate of good standing, a certificate of incorporation. All of these documents are going to come through to us for review at the trust company, and then go onto our compliance team for a final review. This process takes anywhere from 5 to 7 business days if all the documents are clean and there's no questions that we need to ask. We do this to make sure that your assets are completely secure. So from our cold storage, so just the screen up here, it talks about our withdrawal flow. So we use, like I said, we use multi-sig and TSS, but we also have a lot of controls in our platform from a cold storage standpoint. So we allow our clients to initiate the withdrawal. That'll be done on the BitGo platform. And then we have what we call policies in place. These policies are going to allow you to control the users of your account. That's going to allow you to create spending limits, different people that can access your accounts and do different things on the account, initiate a transaction, be a video verifier. So once you have initiated that request, you can put those policies in place that potentially your withdrawal wants to go through multiple approvers before it comes to us for signing. That would go through your policy. And then there's going to be, depending on a certain amount of transaction qualifications, a potential for a video approval. So what that means is that you're going to come to us, you're going to do a video, you're going to verify some information on your transaction. And once that's done, it'll come to BitGo. Once it's at BitGo, we have a team of specialists that will review that video for verification of that transaction to ensure that it's you or your company or your delegated representatives that's doing that transaction. We will watch that video, verify the information, and then we're going to co-sign that request. Going back to multi-sig, right? So there's the platform key, which is your key, and then there's our key, which we co-sign with. Once that we have co-signed that transaction, it's going to be approved and broadcast. All of these steps are in place to ensure that your transaction, your assets are as safe as possible on our BitGo platform. We are also very flexible on what policies are in place for you so that we allow you to create your own comfort at your end while knowing that BitGo has your assets secure on our end. So I'm going to stop talking about all the great things about custody, and I'm going to hand it off to Jeff Horowitz to talk about all the compliance stuff and state of regulation.
Thanks, Jody. So first, let's talk a little bit about a compliance team structure. Right? We're set up similar to any traditional bank, broker dealer, trust company. We're just custodying a different type of asset. So it starts with a CCO who plays the role of a quarterback for managing a comprehensive compliance and risk program. We have leaders dedicated to our BSA and sanctions program. We have a dedicated financial intelligence unit. We have someone focused on ensuring that all our employees get properly trained, manage conflicts of interest policy, and executes on our compliance monitoring testing program, very similar to a traditional bank or broker dealer. We have a team in Sioux Falls that focuses on our KYC and onboarding customers to our trust company. And as Jody mentioned, we're regulated by 4 different regulators around the globe: the South Dakota Division of Banking, New York DFS, and 2 foreign regulators in both Switzerland and Germany. So someone actually manages all of those exams from various federal and state regulators. Regulators are used to seeing a similar structure to what they've seen when they've examined other banks and broker dealers, and we're set up to meet those similar standards. How do we do that? Well, we utilize a number of leading industry surveillance programs, including Elliptic for our blockchain analytics, Unit 21 for transaction monitoring, Cloudflare for our IP blocking to meet our sanctions obligations, just to name a few. We live in a world where we're looking at the spirit of the regulations, given the lack of clarity from our regulators, and we're trying the best to interpret and meet those standards. So a little bit about where we're at in our state of regulation. Back in March, the White House, through an executive order, acknowledged both the potential for crypto, but as well as the need for the U.S. to clarify its regulatory stance. That order asked a number of agencies to research and report their findings, including protection of consumer investors, financial stability, and mitigation of systemic risk, as well as the reinforcement of the U.S. leadership in the global financial system and in technological and economic competitiveness, including through responsible development of payment innovations and digital assets. So where does that bring us? In the most recent reports just issued this week from multiple regulatory bodies, they've clearly honed in on the potential risks in crypto and focused on enforcement actions rather than a balanced approach of both the benefits and opportunities that crypto can bring into the U.S. economy and the financial system. Clearly, crypto isn't fading away, and the federal government is spending attention on this emerging technology. One of the biggest questions that still looms is what constitutes a security offering. We're still stuck in a land grab between the CFTC and the SEC with little regulatory clarity other than through enforcement actions. So that led us to a couple of bills that were introduced, one from Senator Toomey back in April. They really focused on how banks would be permitted to issue stablecoins, but it also set out certain regulatory paths for allowing issuers to be registered under state money level transmitter regimes or creating a new federal license under the OCC. Issuers would be required, subject to a series of disclosures on reserve assets backing those stable coins, what are the redemption policies, and would be required to undergo quarterly attestations by a regulatory public accounting firm and make those results public. That was then followed by Senator Loomis and Gillibrand's comprehensive bill back in June, which focused on areas that need clarification and who should provide that oversight. The CFTC in their bill would likely be a lead regulator for most digital assets that are not deemed securities. There were additional disclosure requirements, reserves for stable coins, as well as a de minimis amount of up to $200 for taxable events if that was used for crypto use for payment or goods for services. That brings us to the White House framework on crypto regulation. So each of these regulatory agencies had about 6 months to come up with some new announcements. And mostly what came out of that is a continued study of the risks and the opportunities in the crypto space. But one most recently, the Treasury Department came out on Monday, and they had 20 questions, and that they're asking about for the industry's participation into what's crypto's role in illicit finance, potential money laundering and fraud and theft schemes, as well as corruption. And they're seeking comments on how best to mitigate these risks through regulation, additional supervision, public and private engagement, oversight, and law enforcement. Sandwiched in between all of those 20 questions was the last question, which was about how do we effectively support the incorporation of AML and CFT controls into a U.S. central banked digital currency design. Look, I am happy to see that the Treasury is asking for input from the industry, how we can better form public-private communication and try to mitigate the risks, because there are some risks in this industry, but to do this with an open mind. That comment is out until November 3rd. So if you're participating, please comment. I think this is the only way we're going to move the ball forward. And look, at least there are considering what should be tweaked in existing regulations and acknowledgement that the existing framework may need to be modified, which is a very different response that we've received to date from the SEC. And last, there was also an SEC guidance called SAB 121, which advised that publicly traded companies, including banks, adjust their accounting treatment for digital assets from an off-balance sheet to an on-balance sheet, requiring crypto assets to also be recorded as liabilities and provide for the provision of additional disclosures regarding the value of those assets. If SAB 121 affects your custody plans, please reach out to BitGo on how we can help, as we are not a publicly traded company and not currently subject to this SEC guidance. I think the regulatory takeaway is that crypto has not faded away, and both federal and state regulators need to focus on a regulatory framework that mitigates certain risks, but allows crypto activity to continue to mature. Because if not, most of this activity will migrate overseas, which does little in way of consumer protection and further erodes our role as a leader in the financial markets. I keep a notebook of every week what new regulations are coming out. I think we're going to get a flurry before the end of the year because, as I said, I think the regulators have woken up that they need to address what the risks are and what the opportunities are. And with that, I'll turn it over to Adam.
Thanks, Jeff, and thanks, Jody. So, look, here we're going to talk about the different segments and what we're seeing in the institutional space. So BitGo offers a complete solution across all these segments, and really it's a matter of understanding our clients' needs and which combination of tools fits them best. Traditional hedge funds, we're seeing many of them starting to increase their exposure to digital assets. Many are in the due diligence phase, exploring providers, determining what strategies that they want to deploy. I'd say about 90% of the hedge funds that I've reached out to since joining BitGo have at least wanted to have a conversation, right? So they're, a subset of them are thinking about moving forward, but they all at least are in the exploratory phases of trying to understand where the market is. PwC put out published a hedge fund report in June that said a third of traditional hedge funds were investing in digital assets, 2/3 of those and plan to increase their allocations. And I think that's fairly in line with what we're seeing with really the larger multi-strat firms being the most active in the space. From an asset manager side, I'd say it's still early stages of deploying spot strategies. We've seen some active in trading futures. We've seen some large asset managers recently hire some talent with digital asset experience to help with their build out. But I'd say those that are doing so are doing it with internal assets and helping set the stage so that as the regulatory environment changes, they have the infrastructure ready to scale up. In the family office space, I think it's about coming off of zero. And when we say zero, it's a 0% allocation historically to somewhere from 1 to 5%. We recently published a case study that covered a good amount of a couple of our existing family office clients. Many of these are long-term holders. They're open to lending digital assets or cash to us as well through our prime brokerage offering. And they see that as a way to help offset the custody fees and earn incremental yields. RIA space, we recently launched a platform for wealth management that helps them scale their sub-accounts. I think our structure as a qualified custodian and the infrastructure that comes with the wealth management platform will help solve some of the barriers of entry that have historically hampered this segment. So I think we're expecting to see some strong demand and growth for this segment, I'd say end of this year and next. banks, I think Jeff touched upon it. It really, SAB 121 is the story there, and the bank's interpretation of what the opportunities are. I think we've seen some considering sub-custody, some looking to trade with us, and others looking for loan servicing where we can act as a tri-party on digital asset loans. So a lot of our discussions have been around JVs and partnerships and trying to understand how we can help the banks move forward. And I think, but longer term, certainly some of the regulatory clarity is needed to scale with at least the G-SIFIs and the largest banks. The VC space is definitely a growing segment for us. Some of these are registered funds that need qualified custody. For many of them, it's about coin and token coverage, and they like how quickly we can also add tokens to our platform. Some of them have had early stage investments that become sizable staking opportunities, and we've seen that with some of our recent additions of Near and Solana, where we've seen strong demand in the VC space. Miners and crypto native hedge funds, these tend to be focused around custody and financing. They work with our prime brokerage team. That's a good percentage of our borrow and lend book today. They like our competitive financing rates as we're able to source billions of dollars of custody assets to provide liquidity to our clients. And then I'd say as well in the crypto native hedge fund space, we have our MMI solution that allows clients a secure and safe way to access the DeFi market. So I think across all these segments, the bottom line is we have solutions for all the institutional clients entering digital asset space, and our sales team spends time getting to know their needs and trying to determine the best way to partner with them going forward. So with that, I think we'll let's see. We do have some a question. What are some top questions people should ask custody providers to make sure they are secure and compliant? Jody, you want to take that one?
Absolutely. I can take this. It's a great question, and largely why we're here today, right? We want to make sure that your assets are completely safe. So, number one question I would ask is if and where the custody provider is regulated, right? At BitGo, like Jeff talked about, we are regulated by 4 DFS, Division of Banking in South Dakota, GmbH, and BaFin in Germany, right? So ask that question. It's number one. And there's ways to actually verify that as well, right? So ask that question. And then second, I would start asking about their audits. Are they SOC compliant, right? Those types of questions are going to get you to the real answer that you want. Are the assets you're going to hold with that custodian secure? At BitGo, they are. And then, after you get to that point, you might want to ask a little bit about how they hold those assets. Is it in cold custody, right? Is it a complete technology solution? Is there human intervention? Is it a mix of both? That's what BitGo has. So we don't have a breakdown in one or the other. So lots of great questions, but really focus on where they're regulated. What's their compliance process? Do they have SOC? Those are the questions I would ask. Can you go into more, lots of questions. Can you go into more importance of the single point of failure and how that sets BitGo apart? Yeah, so separating the keys, right? So for example, you wouldn't want to keep all of your passwords in one notebook, right? So you want to make sure that they're segregated and they're separate. So having keys held at BitGo that are securely taken care of in our bank grade vault, right? We want to make sure that those keys are separated. That's going to allow there not be a single point of failure, one person controlling your asset end to end. There are multiple touch points, whether it's of the client and policies set in place or at the key signing standpoint, right? So we actually hold a piece, it's an M of N sharded key. So there's multiple people that actually have to come together. It reduces the single point of failure or the risk of collusion. You do have a part of this that's technology and a part of it's human again. So I don't know, Jeff or Adam, if you want to go into any more on that, but definitely having segregated keys is going to help you.
Yeah, 2 things to note. 1, we have a SOC 1 Type 2 for our trust company. 2, we're an independent qualified custodian. We are not tied to an exchange. Many exchanges are our customers, but sometimes when those assets are held on an exchange, that's very different than the rules that apply to us as a trust company and the fully segregated control of those assets. So you should be looking for a qualified custodian to outsource your custody to.
John, thanks for those questions. Doesn't look like we have any other questions queued up. So I think with that, we'll say, hopefully everyone found this session useful, and now you know why all custody solutions are not created equal. So any other questions come in, please feel free to reach out to sales@bitgo.com, and we'll have our team follow up with you.
Thanks all.
Thank you so much.
Thank you.